Hello and welcome to IG's Trading the Markets podcast. Second quarter tech earnings are kicking off this week with Twitter and Intel among those next to report. While the sector is expected to show continued strength, there are some key headwinds from ongoing chip shortages and decreased demand for the so-called stay-at-home stocks. Dan Ives, who's the head of tech research at Wedbush, says that June's results and guidance will be another positive catalyst for the tech sector, which could rally another 10% in the second half. Dan is with me now. Great to see you again. Now, clearly we've seen this massive increased reliance on many stocks in the tech sector during the pandemic, but you believe that these gains can continue from here even after lockdowns and as freedom is restored. So talk to us about what's going to drive tech stocks up another 10% from here.
Yeah, it's really the digital transformation that's sort of the next leg of this growth. We're seeing the cloud, cybersecurity, and even e-commerce. Now, clearly, there's been pull forward with Zoom and some other core work from home names. But we're seeing this just massive tech spending across enterprise, especially on cloud, cybersecurity. And I think it's going to ultimately flow to a lot of the larger names when I look at Amazon, Microsoft, as well as Google. I think we're really going into what's going to be a fork in the road situation that's going to lift tech higher as these numbers come through for 2Q.
So cybersecurity spending is one area that you're particularly bullish on. What are some of your favorite names in the sector and what's behind your optimistic outlook?
Yeah, and I think you see the threat environment is unlike anything we've seen, in terms of the hacking from China, Russia, just well as a lot of the malware attacks. So I think these are trends that are going to continue. It's $1 trillion market opportunity. Love names like Zscaler, ZS, CyberArk, Tenable, also a Palo Alto. I think you're really starting to see next leg of growth there, as well as a name like Varonis. I think there's also ways you play the enterprise, but then you also play federal spend. I think federal incremental spend, names like Telos and Palantir, we're really starting to see next leg of growth there because the Beltway is really starting to spend on cybersecurity.
You're also very favorable towards the cloud with names like Microsoft being the obvious one, but also DocuSign and Pegasystems. At the moment, you've noted that only 40% of workloads are currently on the cloud. How do you expect that to evolve in the coming years?
Yeah, and we think it goes from 40% today to 70% in the next 3 years. So Microsoft, I think, is the biggest beneficiary disproportionately on cloud. I think they've also gained some market share versus AWS. And you're starting to see Google, even IBM start to gain some share in terms of overall cloud. But you look at the ecosystem, names like DocuSign, Pure Play, e-signature, contract lifecycle management. I think that's only a quarter penetrated in terms of the opportunity. Also names like Pega. Those are cloud transformation stories. And then even you look at the areas like the call center. I mean, look, Zoom just bought Five9. There's a company called NICE Systems, NICE, that we really are bullish on in terms of this call center cloud shift.
Now, in terms of some of the individual names, Tesla due to report earnings soon, having already reported record vehicle deliveries earlier this month. But we did see that CEO Elon Musk warned of chip and material shortages. That's something that we've been discussing before. You still have an outperform rating on the stock and a price target of $1,000. That would require more than 50% rally in the shares from here. So what makes you so bullish and what are you expecting in terms of the numbers this quarter?
And this is a longer term view. I mean, chip shortage obviously near term is a headwind, not just for Tesla, but other automakers. But if I look long term, EV, we're only 3% penetrated today. I think what Tesla's doing, even though they've hit some speed bumps in China earlier in the quarter, starting to see demand significantly rebound. I think that's a big opportunity, 40% of overall deliveries next year. Then you look at Model Y, you got Cybertruck coming out next year. I think this is part of the green tidal wave. And Tesla's one of the ways to play it along with GM, NIO, Xpeng, and others in terms of this EV thesis that I view as the fourth industrial revolution in terms of what's happened to the auto industry.
Now, we know that Elon Musk doesn't necessarily love playing along with the analyst community and fulfilling his role as a traditional kind of CEO as a public company. So there's always the potential for some surprises from him. Do you think he could surprise us this quarter?
I think the biggest focus in terms of Musk on the call is trying to understand some gauge on deliveries in China. It's the capacity build outs within Berlin and Austin. I think those are big focus areas as well. And just maybe him trying to give some update on battery technology. I mean, if you look what GM's done, significant sort of inroads in terms of what they're building out. I think investors want to hear a little more insight, because part of why Tesla's and stocks underperformed this year, a historic year last year, it's because there's more competition, and investors want to make sure Tesla continues to be a step ahead.
Now, elsewhere in the tech sector, Apple remains your top pick. Its share price obviously not far off all-time highs, and it's had a history of beating in terms of EPS, beating in 3 out of the last 4 quarters. Do you think the shares are a buy heading into earnings?
I do think it's a buy heading into earnings, because this baton tandem from iPhone 12 to iPhone 13 super cycle continues to play out. I think the street originally underestimated demand, but I think you're starting to see it now in terms of Asia checks. And then services. Services is a big part of the re-rating story in Apple, which is why I think a year from now, $3 trillion market cap for Apple, and we continue to be buyers into earnings.
Now, taking a step back and looking at the Nasdaq overall, we have seen a bit of a wobble in recent sessions. Monday saw its 5th straight day of losses. It's the worst losing streak since October. Is this a buy the dip opportunity, or could this be the start of something a bit more sinister?
We view it as a buy the dip. We still think Nasdaq 16,000 year end. The secular stories, I think, really play out into the second half. I think it starts with 2Q. You're going to have some of these COVID fears, macro reopening worries, and that's going to continue to sort of be there just given the nature of the situation. But in terms of tech, I think still re-rating higher. We be buyers on these dips that we're seeing, especially the secular stories, cloud, cybersecurity, 5G. Of course, Microsoft is one of our favorite cloud large cap. I think that's the way to play this.
All right, Dan, thank you so much for your time. It's been great chatting to you as always. And that was Dan Ives, Head of Tech Research at Wedbush. I'm Victoria Scholar, and thank you so much for listening to this episode of IG's Trading the Markets podcast. Now, if you did enjoy today's podcast and you'd like to hear more from us, don't forget to subscribe.
For more videos like these, you can follow us on Twitter, Instagram, and subscribe to our YouTube channel.